We think we will get another cut in December. It is interesting watching the crypto ecosystem really be a leading indicator when liquidity is ebbing and flowing. I think that's primarily what's going on here. This liquidity squeeze, we think, is going to end within the next month. And that's probably the most important point. Sure, there are these competitive dynamics between the various L1s and L2s as well. Gold price appreciation has been far greater than we expected. So net, our bull price, which most people focus on that one, really hasn't changed.
Cathie begins by addressing the core issue affecting risk assets today: liquidity. Markets have been tight, fragile, and volatile because global liquidity has been under pressure. But according to Cathie, these pressures are transitory and already reversing. She outlines three key drivers. The Federal Reserve hasn't ended QT yet, the Treasury General Account, TGA swell, and interest rate expectations. Cathie believes the liquidity squeeze will end within the next month.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
We are in a bit of a liquidity squeeze. We think it's temporary. There are three reasons. One, we've seen the Fed, as of the last meeting, not end quantitative tightening. Many people expected them to do it at the last meeting. We think they will do it at the next meeting, so that's December 10th. The second liquidity squeeze is related, and hopefully we can say now was related, to the Treasury General Account. When the government was shut down, the Treasury's cash balances were building. They were not dispersing the cash. The government shutdown is over. It's going to take a little bit of time to ramp and get everything back to normal. But we think that source of a liquidity squeeze is behind us. And now we're dealing with the third, and it really has to do with interest rates. Will they continue to come down? The market had been thinking, yes, they would, and we'd get another cut in December. We think we will get another cut in December. And that the Fed will shift from what seems to be a hawkish tone right now back into a more dovish tone as we approach that date. We're seeing inflation really come down significantly. Maybe we don't have the government statistics, but we do have the bond market, which is helping us understand that as measured by the 10-year Treasury yield, the inflation expectations have been coming down for the last few months. We're in roughly the 2.5% range on that metric. Same is true for Truflation, which is a real-time indicator, 10,000 items monitored, tens of thousands, I think it is, monitored in real time. And that metric is at roughly 2.5%. Now, it was down to roughly 1.5%, has come up here. Tariffs, of course, are a big reason. We think tariffs are going to wash through as well, and some may even come down. We think this liquidity squeeze will pass as the government opens fully, as quantitative tightening ends, and as interest rates continue to come down in response to weakening employment and inflation indicators that are pointing down. It is interesting watching the crypto ecosystem really be a leading indicator when liquidity is ebbing and flowing. I think that's primarily what's going on here. This liquidity squeeze that I mentioned at the beginning, we think is going to end within the next month. And that's probably the most important point. Sure, there are these competitive dynamics between the various L1s and L2s as well. And we're always doing deep dives because there is so much data out there. It is so transparent. But we think the restructuring of the financial ecosystem is also in the first inning. What has happened is that stablecoins are usurping one of the roles we thought that Bitcoin would play, meaning an insurance policy for emerging markets, meaning the individuals in emerging markets whose wealth and purchasing power are destroyed regularly by bad fiscal and monetary policies or by corruption. And that is not happening. However, what is happening at an accelerated rate, interestingly, is the scaling of stablecoins, which I think have scaled to nearly $300 billion. And the other side of that is this has become a natural buyer for U.S. Treasury securities. As China and other countries are diversifying away from the dollar, we've got a big force here, and we think it's only the beginning in the form of stablecoins, which are backed primarily by U.S. Treasury securities. The impact of the increase in the gold price, I said all other things equal. Well, all other things have not been equal. The stable coins have accelerated, taking some of the role away from Bitcoin that we expected at least. But the gold price appreciation has been far greater than we expected. So net, our bull price, which most people focus on that one, really hasn't changed.
Cathie addresses an MIT research paper claiming corporations haven't seen productivity gains from AI, implying AI excitement might be a bubble. She disagrees, but acknowledges a nuance. Enterprise transformation is slow. Consumer adoption is fast. Companies must restructure deeply to use AI effectively, a process that is expensive, complex, and time-consuming. Consumers, on the other hand, are adopting AI instantly. She uses Palantir as a case study. U.S. commercial revenue surged 123% last quarter as CEOs increasingly acknowledge we must adopt AI or we will lose our competitive edge. The seeds planted during the 1990s tech boom are now bearing fruit. Cathie believes the AI revolution is in the first inning, not the ninth.
We're seeing other metrics, though, that suggest that affordability is going up. One of those is oil prices. West Texas Intermediate cracked $60. And there are cyclical and secular reasons for oil prices to continue falling. Housing prices and shelter in the CPI is roughly 40% of the CPI. Housing prices, new home prices have been falling for roughly a year. Existing home prices or home price inflation is down to 1.5%. And that will get into the CPI over the next year. And then finally, we're seeing a lot of technology indicators, and this is our bread and butter. The metrics we follow and the original research we do suggest that the undercurrents of deflation associated with new technologies evolving are building. And we would not be surprised to see a real break in inflation once the tariffs have passed through in the next year. Now, the burden of proof is on us. I've just given you three indicators that suggest inflation could come down significantly in the next year. But it has been stuck for the last year in that 2.5% range, give or take a little. So we think it will resolve on the low side of expectations. We're surprised at what the Fed is saying right now, the various Fed governors, especially because the employment indicators are weakening significantly. Sure, we don't have the government employment indicators, but ADP is out, and month after month now, they are saying that employment is either contracting or expanding very, very slowly. And we're also seeing new graduates. That unemployment rate is increasing more rapidly than any other cohort's unemployment rate. And I think the duration of unemployment for everyone is approaching 30 weeks. So these are indicators that suggest that the velocity of money it has already flattened out, and we think it will go down on a year-over-year basis. M2 right now is up 4.8%. If the velocity of money falls on a year-over-year basis, that means nominal GDP will probably drop below 4% or 3%. And nominal GDP includes both real GDP and inflation. So the combination at 3%, something's going to give. And right now, it seems like the real side of the economy is starting to capitulate, as measured by labor, at least. As productivity increases, maybe it won't hit the real growth line, but it is hitting labor. And of course, inflation would be the other give. Many people are worried about that risk out there. And this, in comparison to what was going on in the tech and telecom bubble, is night and day. In the tech and telecom bubble, sure, you had some value investors saying this doesn't make sense. No one was listening to them. And you had growth investors just throwing money at the dream back then. The seeds that were planted in the 20 years that ended in the tech and telecom bubble have been germinating for the last 25 to 30 years. Back then, the technologies were not ready. The costs were way too high. We didn't get the cloud until 2006. We didn't get the first real breakthrough in AI until 2012, deep learning, and then the even bigger breakthrough in 2017, that was transformer architecture. And of course, we had the ChatGPT moment as in late 22. We think this AI story has just begun. We are in the first inning. And the only thing that I will flag as a nuance and is related to an MIT research paper that came out on this topic a few months ago. Basically saying corporations aren't seeing any productivity gains because of AI. This is completely elusive. It is a bubble. And the only nuance here is for enterprises to restructure and transform completely, which they will have to do in this new age, is hard work, and it will take time. And yet, on the consumer side, it is flourishing. So I think that bifurcation is something that we think about a lot. But if Palantir is any indication, and we think it is, you have CEOs and strategic decision makers saying, we've got to do this or we're going to lose our competitive edge out there. And that's why U.S. commercial business was up 123% last quarter, far surpassing anyone's expectations, including our own.
Cathie Wood's analysis paints a clear but nuanced picture. Today's market stress is real but temporary. Liquidity is tight, but the three major drains on liquidity are all reversing. Inflation is already far lower than official statistics suggest, employment is weakening, and a deflationary wave driven by technology, housing, and oil may soon force the Fed to pivot dovish. Meanwhile, the crypto ecosystem is proving once again that it leads liquidity cycles, while stablecoins are quietly transforming into a system-level buyer of U.S. Treasuries and a foundational layer of the new financial architecture. And behind it all, AI, still in its earliest stage, is laying the groundwork for a massive productivity boom.